Is Meta stock going to be the best dividend growth stock out there? We're going to take a look at this company that has recently just started to pay a dividend. We're going to take a look at the historical performance. We're going to touch upon their income statement, their top line revenue growth, as well as their bottom line to see how strong this company really is. We're going to look at the health check, their total cash versus their total debt. We'll also see how well they've performed versus some competitors, whether or not they are the strongest in the industry. We'll also touch upon their dividend safety. They have just started paying a dividend. We'll also look at some in-depth financial metrics. We'll look at their free cash flow per share, amongst others. We'll also discuss the sell-off that Mark Zuckerberg has been doing, the CEO. He has sold a ton of shares over the last few weeks. We'll also look to the institutions to see whether or not they are still adding shares of this company after they have announced they are paying a dividend and the share price has gone up significantly. And we'll also give our thoughts on the valuation of Meta right now, the intrinsic value. We'll look at the acceptable buy price. We'll give our investor margin of safety, and we'll see Wall Street what they're expecting in terms of upside over the next 12 months. Now, Meta is a stock that is up tremendously. Now, over the last 10 years, it is up 606%. We can see it was trading for just under $100 not too long ago, nearly up 5 times that. And over the last year, they have been on a very strong run, up 173%. They're trading now at their 52-week high. They offer a forward yield of 0.41%, and we can see their forward P at 24. So let's talk about Meta. Let's get into their numbers. Now, on the top line revenue, what we typically after for a standard company, 3 to 7% growth year on year. December 2019, $71 billion on their top line. 2023, their latest annual report, nearly double that at $135 billion. Now, we can see their growth has been very, very sporadic. We see 2019, it increased to 86, and then it increased to 118, before falling very slightly, and then another massive jump. So yes, it does increase significantly over the longer term, but there are some inconsistencies when we break it down over the last few years. To top it off, their bottom line, $18.5 billion of net income in 2019. They've more than doubled that over the last 5 years. 2023, $39 billion. Now, their bottom line, a lot more inconsistent. We see it increase from 2019 to 2021. We then see a large drop in 2022 before picking back up. So we do note that their share price did drop quite considerably alongside that drop on the bottom line. But those shareholders who either bought at that point or those shareholders who held onto the stock were rewarded very, very strongly. In terms of a quick health check then, total cash versus total debt. $55 billion of cash and short-term investments in 2019, $65.5 billion in their latest report. So not only do they hold a very large amount of cash, but it has increased from the last 5 years. Now, in terms of comparing that to their total debt numerically and directionally, it has gone up considerably from $10 billion to $38 billion, nearly 4 times. But we do also note that they have a large cash position, which is larger than the total debt. So it wouldn't even take them one day to pay off all of that debt. Now, very quickly comparing them to others in the interactive media and services, we have Alphabet, we have Tencent, and a few others. Now, over the last year, no surprise, Meta has had some incredible return, 173%. In fact, we do see the next competitor there, Google, around 47%. So very, very strong. Extending that to the last 5 years, we see Meta again the best performing, up 198%, and Google isn't too far off at 155%. Now, one thing that is very imperative to understand here, past performance isn't an indicator for future. Meta has been incredibly strong. Who's to say they may not surpass that and go up 300, 400% over the next 5 years? But also bear in mind, past performance isn't an indicator. We just use it as one layer of our analysis. Now, what we typically do with these companies, we run them through the insider buying and selling screener. So we look for all, so buy and sells, minimum 100 shares. And now we put over the last 14 days. The reason why, if we extend this to the last 3 months, we are going to see a lot of activity. In fact, the majority of that, if not all of it, is selling, and there are more pages. So the reason that we've done here is the last 14, just to be a bit more accurate, to reduce down this number, but what we can say here is the majority of the sales has come from Mark Zuckerberg himself. We're talking hundreds of millions in total. Now, two things we want to point out here. Firstly, insider buying, we don't see any of that right now, but that is a bullish signal. As Peter Lynch, the GOAT, says, if insiders buy, it's for one reason: they expect the share price to go up. Now, insider selling that we see here isn't typically a bearish signal. Management sell for many reasons, whether personal or financial. What we can see here, though, Mark Zuckerberg is selling a lot of his shares. And the thing I want to point out here, one of the reasons why we do say it's not necessarily a bearish signal, we can see since he sold, in fact, the latest one that he sold 2 days ago, the share price from that point is up 3%. So a little bit of food for thought there, just something to bear in mind. But again, this is just one level of our analysis. Now, for those who aren't subscribed to our free weekly newsletter, click on the pinned comment, completely free. Our latest article, we actually run through companies where insiders have been buying a lot of shares, which is a very bullish signal. We've also touched upon some where insiders were selling, and we have other articles, one which explains our 7 golden dividend metrics on how we find undervalued companies, and there are others, and today we are releasing another one. So let's take a look at institutional ownership. It currently sits at 63%, around 47 billion worth of sales by these institutions over the last 12 months. Over the same period, a massive amount of buying, 290 billion, and we can see the largest buy at Q2. Now, Q3, Q4 as well. In fact, the latest quarter, we also see management buying more shares. So, as always, something just to bear in mind, whilst these institutions are buying a lot of shares of Meta, more than they are selling, we should always do our own due diligence. Again, this is just another level of our review. Dividend safety, now they just essentially started paying a dividend, so we have a score here of 70. Market cap, 1.23 trillion. It is a mega cap company. Now, dividend metrics, or in fact recessionary metrics, they didn't pay a dividend during the last recession. Very interesting to note, though, in the last recession, they had 154% positive growth, which was well above the average growth of companies in the S&P, coming to negative 12%. Now, they have essentially done a dividend declaration, 50 cents due in March 2024. Now, in terms of dividend yield theory, again, very, very hard to use this given they have just paid a dividend, so we should ignore this. We can, however, look at the forward PE. We see a score of 24.4 versus 22.1, so it's currently trading slightly higher than the 5-year average. And we also note that it is significantly higher than the communications sector PE of 17.6. Now, in terms of the free cash flow payout, again, it isn't something we can talk too much of given they've just declared a dividend, but we do note that when they do pay it for the full year, it will be around 11%, so very, very low, pretty much in line with the big tech companies in the Magnificent Seven, like Microsoft, like Apple, so something just to bear in mind there. More importantly now, the free cash flow per share, and for those that are new, we do ignore earnings data. It is susceptible to manipulation by management through accounting. This is very nice. It's increased, in fact, very, very strongly, more than 8 times over the last 10 years. We do note that dip, which did coincide with the share price fall, but 2024 expected to go even higher, so their free cash flow is increasing year on year. Sales growth, now for typical companies, as we mentioned at the beginning, steady moderate growth, 3 to 7%. This is a tech company. Always understand what type of company you're investing and have realistic expectations. Double digit every single year. Now, if you've watched regular viewers, you know I'm about to point out now that this, whilst very strong, has been decreasing pretty much consistently year on year. Something just to bear in mind, not to say necessarily it won't continue to grow, but we are seeing a downward trend, and maybe they will start to turn this around, and it'll be interesting to know what they have in store for the future. Numerically then, they've more than 10 times their top line, 12.5 billion in 2014, 135 in 2023. Now, they do share buybacks. They also issue shares to dilute your position. The net position overall is a net buyback of around 30 million shares. Nothing really too much to note there. ROIC, again, if you do pick up that newsletter, one of those talks about my 7 golden dividend metrics. The ROIC is one of them. I want to see 10% or more consistently. That gives me faith that management are able to effectively allocate their capital. And we can see here, not only is it above 10%, but it is also increasing, 26% in the latest year, absolutely phenomenal. And the margins, very strong, above the minimums, both on the operating and the free cash flow. Very, very positive, especially in the latest year as well that we can see. In terms of the net debt to EBITDA, again, I did explain this earlier. Essentially, earnings before interest, tax, depreciation, and amortization shows us, one, the balance sheet strength, 2, the dividend safety. This shows us that it wouldn't even take them one day to pay off all of their debt net of cash on hand. A phenomenal metric. So no worries there, especially when looking at that balance sheet. Now let's jump into the valuation side. As always, if you enjoy the content, values being provided, smash that like button, hit the subscribe and bell button so you are continually notified of these videos as they drop. So the first model we're using is the multiples valuation model. Companies in a similar sector and size. We get the average P multiplied by the EPS of Meta to get an intrinsic value showing undervaluation. So very strong, but as always, bear in mind we're not looking at any of these models in isolation. The second model would typically be the dividend discount. However, they've just started to pay dividends, so we don't believe it to be relevant just yet. DCF model, we have the free cash flow year on year. Average growth rate 32%. Forward looking, we've gone lower than the average. We've also gone lower than analyst expectations. With that discount rate, we get the present value of future free cash flows and terminal value. Add together with the cash, subtract total debt, get to the shares outstanding, and then we get an intrinsic value of $487, slightly higher than the current market value. So the intrinsic value for today's episode of Meta is just the average of these two models, and it comes to $536. Now, typically on the channel, we use a margin of safety, which we start off with 10%, and we use that if we believe it meets three criteria. That is a wide moat, strong financial metrics, good forward-looking data. Using that for Meta, we pretty much see it at the current trading price, so we see around a 10% margin of safety. Now, in terms of Wall Street and their expectations over the next 12 months for Meta stock, they have upside of 10%, not too far off our intrinsic value, so they do believe this to be a fairly strong stock. $529 price target. As always though, do let us know your thoughts in the comments below whether or not you do believe Meta is a strong company. Now, my own personal strategy, this is a strong company, however I do hold it, indirectly in ETFs. It isn't one that I will be adding to my portfolio right now, but it is nice to know, one, that I have it in the ETFs, and two, it is starting to pay a dividend, which will increase that exposure of dividends through the ETFs that I hold. As always though, keen to hear your thoughts. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, I'll see you on the next one.